I think everybody that has a mortgage, okay, that has equity, you should get one. We're already doing it, as we speak, at a different level. Like, for example, your credit cards, right? You're using other people's money by using your credit cards. So if he has a $30,000 balance when we sell his house, he'll have to pay that $30,000, at closing.
Let's say I want to get into buying homes, but I don't have the house I have right now. What are some other options that are out there? I heard somebody talk about hard money, and I'm not sure what they mean by hard money, because it sounded like a loan to me to start with.
That's good debt. That debt is producing income for our family, right? And get a traditional loan to buy that home. They typically don't finance distressed homes. Okay.
More than money, it's about empowerment. Welcome to MSI Wealth Chronicles. And today I'm going to kind of take over for a moment because I have something I want to know about. And this man, Ricardo, has the information. Ricardo, my wife and I were talking this morning about actually getting like a HELOC or some type of loan to be able to purchase a little bit of property, pay off some bills, consolidate some things. And on the way in, today I've been reading about that, and I got into something called OPM. And I found out I was a little deeper in the woods than I knew what I was doing.
Yes.
So would you do me a favor, kind of tell me what they mean by OPM and what is it?
Yeah. So the term, right, it's using other people's money.
Right.
Using other people's money to build wealth. And you could take that to like a big magnitude, right? Like some people are leveraging that at a whole different magnitude because we're already doing it, as we speak at a different level. Like, for example, your credit cards, right? You're using other people's money by using your credit cards. And what do you gain from it, right? Because there's benefits to using other people's money. Like if you use your credit card, what are some of the benefits by using your credit cards?
By using my credit cards, we had to pay. We were out. We were on vacation.
Yep.
We had so much money for the vacation. We didn't want to tap into any other resources. Blew out a tire. We had to replace the tire. Used a credit card to get the tire.
Yep. That's a good one, right? Emergencies, right? Points on your credit cards.
Oh, absolutely.
When you use whenever you use your credit card, a lot of people know this. You get points, right? Sometimes you get 1 point for every dollar that you spend, and then you could redeem those points. And now these days you could get anything, right? You could get vacations, you could get money back, you could get electronics. You could buy your birthday presents from there, your Christmas presents, right? Another area where we're already, most of us are already using other people's money is a vehicle loan, right?
Sure.
Are you financing? Do you have a auto loan that you're financing?
This last year I bought a Chrysler 300 and ended up going through Texas Credit Union to get it.
Yep. And think about it. So you're already using other people's money. What did that do for you? It allowed you to be able to buy your car and not tie up your cash. I mean, imagine buying a $30,000 vehicle cash, but instead, right, you don't have to buy it cash. You could use other people's money, and especially if it's it's intelligent if you're using other people's money and that money that they're giving you is cheap. So So imagine if you get what would you rather do? Get an auto loan and get, I don't know, a 3% interest rate, or use your own $30,000, right? So why not use the bank's money?
Right, and hold on to mine.
3% is very cheap. Yep. Use that money for something else, for investing, right?
Yeah.
So you're doing it there as well, right? Auto loans. But the most common thing that you hear the term other people's money is real estate. That's the most common a way that people use it. And basically, it's basically the same thing, right? You use someone else's money to buy real estate to build your wealth. And you mentioned a home equity line of credit, right?
Right. We were talking about, my wife and I actually got in a conversation on what we should use. One of them was a home equity line of credit because we have, be honest with you, I have about $300,000 in equity in my house right now. And we're not sure if we should use that, some other form of loan or something like that.
Yeah, and you could use it so many ways. But first, let me explain to everybody, right, what the home equity line of credit is. HELOC, right, is what it's known for, right?
Right.
But anyways, so right now it's very, very popular, and the reason why is because basically, if you want to tap into your home equity, if you have a home and you want to tap into your home equity, there's really two ways. The most popular ways are a cash out refinance and a home equity line of credit. So a cash out refinance is not popular right now, and the reason why is, what is your interest rate on your home loan right now?
Oh wow, 3.25.
Okay. So watch, and let me ask you a couple questions. So let's just say 3.5, right, for easy math. So your interest rate on your house is 3.5. How much do you owe on your house?
380,000.
Okay, 380,000. Okay, and how much you think it's worth, your home?
The comp said it's sitting at just let's say 800,000 for easy numbers.
Okay, so what'd you say? 380.
380.
380, and it's worth 800.
About 800,000.
What is that? Is that 420?
420,000.
Wow, that's awesome.
That's a lot of money.
Yeah. So see, by doing a cash out refinance, you're having to refinance the entire loan. So basically, you could tell the bank this.
Oh.
You could say, Mr. Bank, I want to get some of my equity. My house is worth 380. My house is worth 380. My house, I owe 380.
Right.
It's worth 800,000. I have $420,000 of equity in my house. I want to get some of that equity, right?
Right.
So a cash out refinance is they'll do a new loan, okay? So let's say they do a new loan for, let's say you only want $200,000 of your equity, right?
Right.
So you owe 380 plus 200,000, right? That's
580 at that
580.
point.
So now with the cash out refinance, you'll get a new loan for 580, and they'll give you the difference of basically the 380 and the 580. They'll give you that cash. Here you go.
Right.
You know, but if you do that today, okay, because it sounds great, but if you do that today, you're going to lose your 3.5, and you're going to get today's interest rate. Today's interest rate is high sixes, low sevens.
Low sevens.
Yep. So right now, for anybody that wants to tap into their equity and they have an interest rate really 6 or lower, I wouldn't do a home equity line of credit. So what people are doing right now is I wouldn't do the cash out refinance.
Okay, got it. I was about to say.
So what people are doing instead is they're doing the home equity line of credit. So with the home equity line of credit, here's what it does.
Right.
It's a whole separate loan, you could say. So you keep
that sounds
the loan
better already.
Yeah, you keep the loan that you have right now, that 3.5, right, on your home. You keep that. You keep making your mortgage payment. But then what the bank will do is they'll look. Okay, let's see if you're correct, Jesse. You're saying your home is worth 800. Okay, we send our appraiser out there and you're correct. It's worth 800,000, and you owe 380. So now what they'll do is they'll give you a line of credit, against your equity. So let's say they give you a line of credit for, we'll use 200,000, just like we did on the cash out, right? $200,000. So now you have a line of credit, right, sitting on the cloud, you could say, right? A line of credit for $200,000 that you could do whatever you want with.
Okay.
And the beautiful part about a home equity line of credit, and I actually made a video about this here a while back, is I recommend that everybody gets one. If you own a home and you have equity, I recommend that you get one. And I just told one of my clients this. I'll tell you here in a second what I told them. But I just told a client that I was talking to yesterday to get one, because he asked me if he should get one. I was like, yes. I think everybody that has a mortgage, okay, that has equity, you should get one. Because you get it, and like I was saying, I was just exaggerating, it sits here in the cloud, right? And a lot of banks that give you the home equity line of credit, they won't charge you an annual fee. So if you don't use it,
it doesn't cost you anything.
It doesn't cost you anything at all. But if something comes up, right, whatever it might be, I'll give some examples here in a second, but whatever it might be, right, an investment opportunity, an emergency, whatever, right?
Right.
There it is for you to be able to use.
Wow.
My client yesterday, his situation was, I sold him a house years ago, like 7 years ago probably. And anyways, he just had, it's an older home. It was built like in the 70s.
Right.
And so a lot of homes that were built in the 70s, they have cast iron piping underneath.
Yeah.
Now all new homes have PVC piping, okay? And the reason why they switched over to PVC is cast iron has a life, right?
Sure.
Right around 30 years, you start having trouble with cast iron piping. So with him, that's exactly what happened, is the cast iron piping underneath his house started deteriorating, and he started getting leaks underneath his house. And the number one cause of foundation issues is moisture.
Moisture, right.
Yep. So that's exactly what happened with him. The cast iron piping started deteriorating. So he had moisture underneath his house.
Right.
That led to foundation issue. He started seeing like, because it was small leaks, right? He didn't notice that he had any leaks, right?
Right, and that's
But he
just a
started noticing-
cascade waiting to
Yep,
happen.
He started noticing cracks, that's a sign of foundation issues. Maybe your doors aren't closing appropriately. Maybe the windows aren't closing appropriately, right? You start seeing cracks along the walls. So he started seeing that. He got a foundation company to go out there. They're like, yep, you need some foundation work. And they told him what I just told you. Hey, you might want to get a plumber to come out here, because the number one reason why someone needs foundation work done to their house is moisture. So he got a plumber to go out there,
Right.
and guess what they found? They found the leaks from the cast iron piping basically deteriorating. The life of the cast iron pipe is basically at the end, right?
Right.
So he's having to change out the cast iron piping to PVC piping, okay? And that's expensive. I don't know if you've ever experienced anything in this, experienced that, right?
No, I've had
anybody
it-
in your family or friends that's had to replace all their piping underneath their house from cast iron to PVC piping. I don't know if you've heard, but it's very expensive, okay?
No, I haven't. I've had
Yep.
some foundation issues on my first house.
Yep.
And we were just adding pylons, and it turned out, it was like a dozen or 2 dozen
Yep.
of them they had to put under there, and it cost me like, I don't know, $10,000 or $12,000.
On your new house that you have right now?
On my old
Oh,
house,
okay, gotcha,
on my first
gotcha,
house.
gotcha.
And it cost me, $10,000 or $12,000
Yep.
then.
Yeah,
So I could
yeah.
only imagine if they got to go in there and dig out all
Yep.
of your current cast iron,
Yep.
that would be, how much did that cost him?
Well, he didn't tell me what it's going to cost him. Well, I think he did, but I already forgot. But
Right.
But I have 2 houses, 2 rental properties where I experienced that. I had to replace the cast iron piping into PVC piping. Right. The first one is a 1,500 square foot home, and this was like 7 years ago, and that cost me $17,000. Wow. Yep. The second one I just did literally 2 months ago. Okay. And this one is a 2,500 square foot home here in Plano. Home was
Right.
built in 1979. And anyways, the bids that I was getting to replace that one was $29,000. But I finally found someone that was able to do it for $22,000. So, but back to the story about my client, right?
Right.
So think about it. Just someone out there, kind of like my client, right? Just an unexpected, $20,000
$20,000 bill. Yeah.
Plus the foundation issue that the the cast iron piping, leaks cost, right? Which was like another 10. So, I mean, here we are, now all of a sudden to fix these 2 issues, foundation and change out the cast iron to PVC,
Worth $30,000
right?
all day long.
How many families out there have that, right? So he called me, for advice, and I told him a home equity line of credit. We sold a home to him, like I was saying earlier, about 7 years ago. So he has plenty of equity. So that's what he's going to do. That's what he's going to do. He's going to go to the bank, ask for a home equity line of credit, and to get a home equity line of credit, right? It's almost like purchasing a home. They're going to look at almost the same things, right?
Right.
They're going to look at your DTI. They're going to look at your credit score. They're going to make sure you have income. The only thing that they're not going to require compared to whenever you're buying a home is you don't have to have a down payment for a HELOC, right?
Right.
So really it's just the credit check, making sure you have income to support this new line of credit that you're about to get, right?
Right.
That way, in case you use it, they want to know and they want to have confidence that you are going to be able to pay it back. Yep. So just really proof of income and credit are the 2 things, right? But anyway, so he's going to get one, and I know he's going to get approved, and he's going to be able to use that to pay that $30,000, right?
Right.
And now he has a choice. I told him you have a choice. You could either now pay that $30,000 as you wish, because the home equity line of credit will give you options on how to pay it back. It's not just like okay, you use $30,000, you have to pay us back $750 per month. No. They give you several options of how to pay it back.
Really?
Several. Yes. You could pay, like if your goal is to only pay very little monthly, you could choose a interest only option, for a couple months where you pay interest only, and then after a while, then you could start, making principal and interest payments. So they
Right.
give you a lot of options, but the other option that he wants to explore is he wants to get the home equity line of credit, fix the house, and then sell the house, right?
Okay.
And then when you sell the house, now because the home equity line of credit is towards the equity of your home. So if he sells a home if he has a balance on the home equity line of credit, he has to pay that at closing. So, so if he has a $30,000 balance when we sell his house, he'll have to pay that $30,000, at closing, So I think that's the option that he wants to take, because he said that the house that he's been in now for like 7 years, he outgrew it. So he's ready, to buy another house. So, but anyways, that's an example of using other people's money. If that tool wasn't there, the home equity line of credit, right? Other people's money, he wouldn't be able to tap into that. What would be some other options that he would have? I don't know, getting some money from family or friends. I don't using credit
an investor
cards,
of some sort.
Yeah.
For him, maybe family or friends.
Or selling the home as is, selling the home with foundation issues and, plumbing issues.
You're going
to lose a lot of money, But if some of these options like the, home equity line of credit weren't there, some people might have to go that route and lose a lot of money. But thank goodness for, the home equity line of credit using other people's money. He's going to explore that option and be able to, get out of this situation that he came across.
One more question about the home equity line of credit. Do you recommend them getting the line of credit as big as they possibly can? Or just do you recommend? You would?
I would. I whatever the max that the bank will give you, I would take that, because now, right, you never know what type of, the example that I just gave you about my client was, an unfortunate, circumstance for him, right? That I mean, I wish that on nobody, but so that's one of the ways that you could use other people's money to get out of your situation, right? A crisis, kind of, you could say. But the other way that, you could use other people's money is what? Investing. That's the most common thing that you use it. So you never know, right, what type of investment opportunity might come, across your plate, right? And I mean, imagine if you only took out $100,000 and then a phenomenal investment opportunity came, and 2 months later it's 200,000. And now you can't explore that option because you only took out 100,000. Yeah, I say max it out, because like I said earlier, it's amazing that a lot of these banks, they're not going to charge you a annual fee to have it. Some will, okay? Some that might be, if you go try to get a home equity line of credit towards the equity of your home and you're shopping, banks, that would be one of the questions that I would ask is, do you charge an annual fee? A lot of banks don't, some do. If somebody doesn't, and all the other terms are the same, go with that bank. So why not max it out, right? And just keep it. And, when something, comes up, an investment opportunity, or a crisis, hopefully, that doesn't happen,
hopefully
right?
That doesn't happen, but it's there.
It's there for you to use, But you just gotta, you gotta be smart. Speaking about other people's money, I mean, one of the biggest advice that I would give is just be smart, right? Like, I tell this to friends all the time, and I tell this to clients all the time. One of my clients, Jose and Veronica, I sold them a house here not too long ago, and they know that I, do some investing, so they're kind of, asking me to, help them out and coach them, and what would you do next? And I said, I'd get a home equity line of credit. So they got one, and so after they got approved for the home equity line of credit, the advice that I gave them, they didn't ask for advice, but the advice that I gave them, right, was, hey, don't rush into investing. That's where I know a lot of people get into trouble. Is they have money, right? It's because it's like money. The home equity line of credit, it's like money, and they rush into it, and then now that's how they end up, investing in the wrong things and end up losing a bunch of money, and then that could really set you back in life, because now if you're going to try to get out of that bad investment by investing more, right? Now you really have to hit a home run, so take your time, don't rush into it, especially with the HELOC. A HELOC, what did I say earlier? They're not going to charge you anything.
Right.
So why rush into it?
Asking you on that, I know one time you actually told me this before, but how long did you have your HELOC before you used it?
Like maybe like a year and a half, almost 2 years.
You'd said that.
I
a
took
couple
my own
of years
advice,
just
right?
sitting there.
Yeah. I wasn't going to just, I don't know, just go with the first opportunity, that came across, my lap, and then just execute that opportunity. No, until the margins were the margins that I wanted to, invest into that opportunity, I didn't execute, And
Right.
so, anyways, yeah, about a year and a half, 2 years. And now, after that year and a half, 2 years, boom, 2 investment opportunities came, back to back. Like I told my wife, I was like, hold on, we're buying 2 houses at the same time.
Oh my God.
Yeah.
How'd you take that?
It was a little stressful because we bought 2 homes
Yeah.
at the same time that we're building our home.
So you were buying 3 homes.
Yes.
Oh, wow.
So there's a home in the Colony. I just finished that one in November. It's already leased out. It leased out in November. I finished it like in October, and it got leased out in November. So we're done with that one. So that the load from finishing that one and it being leased out, that's behind us now. And then there was the Plano one. That one I literally just finished like 2 weeks ago. And it's on the market right now. It's on the market, to lease for $3,500, 2,500 square foot home in Plano.
Wow.
We're leasing it for $3,500. We have 2 applications. We're going to choose one today. Anyway, so there's that one, right? So we're done. We're about done with that one. And that will be behind us. And then our home that we're building finally, after 2 years of building, we're finally going to be done with it. So we'll be in that house in 45 days. And speaking of, your personal home that you live in, that's another example of other people's money, right?
I never thought about it the way you said that.
Yeah,
when you
it
first
is.
said that earlier, other people's money, you're doing it already. My first question was, how?
Yeah.
And then you're like, credit cards, your home, your car, all of those things.
Yeah, because what's the other option if you didn't use other people's money to buy your house? Buy cash, is another option, And how long would it take us to save up, for whatever home you own, right? What did you pay for it? How long would it have taken you to save up to buy that house cash if you didn't use other people's money? The bank. You used the bank's money to finance a house. So you're already doing, other people's money. A lot of people are already doing other people's money, to a certain magnitude,
That kind of takes a little bit of the fear out of it.
Yeah.
Because as being somebody who wants to step into buying a house and investing in something like that, because I would like to buy and hold and own, right? I want to be one of those people who I have 3 or 4 homes eventually, but that moving into that first one and taking that first risky step, you're like, man, I've never done anything like this, but like you just said, sort of have.
Yeah, and it's and I think, like you said, just the fact that now you see that you've already done it, it takes a little bit of the pressure off,
Yeah.
But one of the easiest way, to if kind of like I told you, for other people's money, people relate it more to real estate, right? That's where they relate it to. And you could just take it to, the level that I'm doing it at, right, is small. We have, about 10, 11 properties, but people are buying this home. This building that we're in right now, right?
Right.
I guarantee you someone didn't pay for it cash.
No way.
They used other people's money, So it's all around us. It is all around us.
So we talked about a home, a cash out refinance.
Yep.
Which right now in this marketplace you don't.
Yep.
You don't. If you're under a 5, don't do it.
Unless you have a interest rate, okay, that's higher than a 7%. Okay, if you have a home right now and your interest rate is higher than 7%, yes, then go with the home equity, the cash out refinance, because then you'll kill 2 birds with 1 stone. A, you're going to get money, right?
Right.
You're going to get money, money that you're going to use for whatever, an emergency, for investing, right? But then the other thing is you're going to refinance your home into today's interest rates that are in the high 6s, low 7s, right? So you're getting out of that. Let's say right now you have an 8, right? Now by doing a cash out refinance, you'll have a 6.9, 7, and so that's going to do you.
You're spending less for the same amount.
Yeah. Your monthly payment's going to go down, right? So that's going to help you out. But then on the other hand, you're also going to take out money, take out some of your equity. So if you have a interest rate higher than what the market offers today, look into a cash out refinance.
Right.
If you have an interest rate lower than what the market offers today, right, then more than likely do a home equity line of credit.
So let's say I want to get into buying homes, but I don't have the house I have right now. What are some other options that are out there? I heard somebody talk about hard money, and I'm not sure what they mean by hard money because it sounded like a loan to me to start with.
Yep. So a hard money loan, a hard money lender is basically a private lender, right?
Right.
Me personally, I only recommend using those whenever you can't get a traditional loan. Okay. Because using a hard money lender, a private lender, you could say, it's more expensive. It's more expensive. So that almost should be Plan B. Plan A, is try to get a traditional loan, a traditional conventional loan, a traditional FHA loan, a traditional VA loan if you're a veteran, right?
Right.
A USDA loan, right? And let me give you an example. Let's say you buy your first property, okay? Go for the traditional, conventional loan, okay? Now you have your traditional conventional loan, you have your house, right? Now let's say that you want to buy a second house, okay? Go for your traditional conventional investment loan, right? That's going to be a cheaper loan than getting a hard money loan. Yeah.
Okay.
So hard money loan is, in my opinion, it's like a emergency. It's a Plan B. The only way that I would really use a hard money lender and not use a traditional loan is one situation, okay? It's whenever you buy a distressed home from the get-go, okay? And can you guess why? So in other words...
No, actually I can't. I'm lost on this one.
Okay, in other words, you want to buy a distressed home, okay?
Yep.
You see you're driving home, I don't know. One of your friends tells you they know someone that's selling their home and it's distressed, and you go look at it, you negotiate a price. You negotiate a price, and then you execute the contract. You have the home under contract. Now you got to get the loan, right? So why not go the traditional route with that distressed home? If I just told you that traditional loans are better than hard money loans. So the reason why is this: traditional loans typically will not. Well, not even typically. They typically never do, right? They will not finance a distressed home.
Oh.
You can't go to your Bank of America, call your mortgage broker, Capital One, whoever, Prime Lending, Benchmark Mortgage, whatever, and get a traditional loan to buy that home. They typically don't finance distressed homes. Okay. So if a bank is not going to give you a traditional loan to buy that distressed home, because that's a phenomenal opportunity there, right?
Right.
What do? You don't have it all in cash. That's where you could go to a private lender. Private lender will finance you for a distressed home.
Okay.
Yep. So now, right now, it's okay to get that private, that hard money loan.
Right.
Even though I told you earlier, the hard money loan is typically more expensive. It's okay though, because if you don't do this, if you don't execute with this hard money loan, okay, now what are you going to do?
Nothing.
You're
You
right.
don't have an
You're gonna lose
option.
that opportunity.
Well,
so as long as you account, right? Okay, this loan is $5,000 more expensive than what I was expecting, it to be, because I didn't know that I couldn't use a traditional loan. So this hard money loan is going to cost me $5,000 more than I accounted for. Put that into the investment numbers. Okay, I got this house for $150. This home, after I buy it, I could put $50,000 into it. So now I'm $200,000 into it. Add all the expenses, right? Oh,
right.
The hard money loan cost me
an additional
$8,000, whatever,
$8,000,
right? Total. Okay, just account for it. But if the home could sell for $400, right? You do all the math. You like the margins that you're going to receive, right? Who cares? That the hard money lender is more expensive, right? Everybody's going to win. They're going to win. You're going to win. Everybody wins,
So what's the difference between a personal investor and like a hard money lender? Is there a difference between that? I've heard both be used, like having somebody who is going to be a backer or something like that.
It's basically the same thing. It's basically the exact same thing. A personal investor, right, is basically a hard money lender. That's basically what he is. And a lot of them, you know what they do? So a lot of these hard money lenders, they're lending you money, right? They're lending you money. Okay, so watch. Why are they lending you money? So you could use other people's money. The subject that we're talking about today, right? Why do you want to use other people's money? For investment opportunities. But check this out. Do you know how most of those hard money lenders are lending you money? Do you know where they're getting it from?
Somebody else?
Yes. They typically have a line of credit, a huge line of credit.
Oh, so like if I had
millions of dollars line of credit, and now you could become a hard money lender. You let people, in essence, you could let people borrow, your line of credit. You could say you let people borrow money through your line of credit, and you charge them. Yep.
So you charge them to borrow money from you, and you borrow money from, and you're already borrowing that money with a line of credit.
Yep.
Wow, that seems like just a kind of a pyramid almost.
Yeah. So other people's money is it's all around us, And if someone asks me, what do you think the first step is? Well, number one, what are the most what are the main factors that anybody looks at? Hard money lender,
right?
A private investor, right? A bank that's going to do a traditional loan. What's the main things that they look at? One of the main things that they look at, right, is credit.
Yeah, credit.
A hard money lender typically doesn't go too much off of credit, but they still do look at credit. Okay.
Right.
But kind of like I was saying, what did I tell you earlier is the cheapest real estate money is typically getting a traditional loan.
Yeah, a regular loan.
They, for a fact, will look at your credit. So number one, right? Get your credit and maximize your credit score. Just maximize that as high as you could get it. For sure, get it like above a 620. Okay?
Right, absolutely.
Somewhere around there, above a 620. But you don't want to stop there at a 620. Get it as high as you can. Get it as high as you can, because they're all going to look at your credit. They're all going to look at your credit. And another area that I would execute to try to start preparing, to use other people's money is verifiable income. You have to have income, and that income could come from anywhere. Every walk of life. If you're employed right now, W-2, there you go. That's verifiable income. If you're self-employed, cool. That's verifiable income as long as you're filing your tax returns.
Gotcha.
And, I know you've heard this, so I'll let you say it. What is the most common thing that a lot of self-employed individuals do with their taxes?
They write everything off. They write everything. I got a buddy of mine actually that about 4 years ago, he is a mocap artist. He does like video games and stuff, and he works with Gearbox and stuff in town. And he wanted to buy a house, and it was when I first was starting on with you here, and I was like, look, you're gonna have to start giving income up, because when I looked at it, I know how much he was making, and I know how much he was writing off, and I was like, you are never gonna get approved at this level, and he had to start claiming more and paying the taxes and stuff on it to be able to build up enough of 2 years of history. For 2 years he had to do that.
And speaking of that, and then I'll get back on what we were talking about, right? I just had a client that I just talked to literally right now, and MSI got his credit scores up to the 700s, so he's ready to buy a house. He told me, when I asked him, the three main things, you need to buy a house, credit score, you're there already, a verifiable income, and money, right? He had two of them. The one area that he fell a little short was he was self-employed.
Right.
As soon as he told me he's self-employed is, how much do you report? I told him the most common thing that a lot of self-employed people do is they write off everything, and then they report very little income, and now they don't qualify for much, right? So sure enough, the only income that he was reporting was $45,000. Whenever I got the mortgage calculator out, I was okay, $45,000. What are your expenses? He doesn't have a car payment. His credit cards are at zero. So I was like, $45,000. You're with today's interest rates, I was like, you're probably talking about a $225,000 house. Would that work for you? He's like, no. The houses I'm looking at are like $500,000.
I bet you that shocked him, didn't it?
Well, he was kind of already prepared, So he was like, he asked me, he's like, so what can I do? He's like, two things. You could report more income. The good thing is that we just finished with 2023. I was like, have you filed your 2023 taxes? He's like, no. So A, you could report more income, or B, you could add someone else to the loan that's going to that brings income, that is employed, right? So I asked him if he was married, and you don't have to put someone that your significant other on the loan. You could put whoever you want. You could put a friend, you could put an investor, you could put whatever, but unfortunately the only person that he could put on the loan is his wife, and his wife is a stay-at-home mom, and that doesn't work. So his only option is to report more income. So that's what he's going to do. He's going to report more income. But speaking of what can someone do to start preparing to use other people's money, right?
Yeah.
So I said credit score and verifiable income, right? And then we were at self-employed income, right? So just be careful with the how much are you writing off, right? How much taxable income are you reporting? Okay, you have to have a sufficient amount of taxable income reporting in your tax returns to be able to get loans.
Right, and it doesn't matter how much money you have churning through your business as an independent contractor or a self-employed individual. If it's not reported to the government, the banks can't take it into effect.
Yep.
You've gone through, like the HELOC, the home equity line of credit, the cash out refinance. We've talked a little bit about hard money lenders and investors and things like that. What I'm seeing from this is that a lot of people think of debt as a bad word. Right? If I have debt, I'm in trouble. I want to pay off all my debts. You hear that all the time. You want $1 million? What are you going to do with it? I'm going to pay off all my debts. Really, what you're saying is it's using your debt. That's more important than just paying it off. It's knowing how to utilize it, because like you were just saying, you have what you said, like 11 homes. What I almost kind of laughed at you for a moment when you said, "Yeah, you can go real big with it." I'm kind of small. I have 11 homes, and I'm like, that's small. That's awesome. I want small in my life. I like this small. You know what I mean?
But once you start dabbling into it, right? And start meeting, other people, you have mentors, right? You surround yourself around people that are where you want to be at, like in the area of investing, right? Man, there's some people out there that, oh my goodness. I mean, like even you could even have a mentor that doesn't even know you, right? Like let's say like Grant Cardone, right? He's a big, real estate guru, and I mean apartments and commercial buildings and stuff like that. So I mean, you could just take it to a whole nother level. Yeah.
Right. No, I mean that blows my mind.
So that's why I said it's small, right? Because I want to keep going. Because I mean, what I'm trying to do is, buy real estate and rent out your real estate, and get passive income. Income. I mean, every time you get a property and you generate passive income for yourself, for your family, right? It's almost like you just got a raise. It's call it whatever you want to call it. Call it a raise. Call it another stream of income. But the beautiful thing about that, what I learned, the beautiful thing that I learned about passive income is, aside of you generating another stream of income, right? Aside of that, another stream of income will help out anybody. But the good thing is about that income is that passive income, okay, is one of the it's taxed. It's one of the incomes that are taxed at the lowest rate. Yep. Like
really?
Our ordinary income, right, from our employer. Where are you at? Everybody's different, right, depending on the dependents, stuff like that. But you're probably anywhere between 35 to 50%, probably.
Close to 50, because I don't claim. I don't claim a lot because we prefer not to have the problems at the end of the year.
Yeah, exactly. So, anyways, passive income, right? You could get that down to, zero. 20%, 15%, 10%, you could get it low. So in other words, that income that you're generating through your one property that you have or multiple properties that you have, right? You could do write-offs and stuff like that, right? Because from that passive income, right, you could write off certain stuff, write off the depreciation of the home, write off the insurance of the home, the taxes, the repairs, right?
How much you're paying for the house.
You could actually, even though you're generating income, that passive income, you could actually pay no taxes on it, So so that's why a lot of people like going that route with real estate, because that's one of the areas that I just mentioned is that income is one of the lowest taxed incomes out there. Yep.
I actually didn't know that.
Yep.
Now, you've talked about using other people's money. Talked about right now we're talking about being able to use the ability to get debt to leverage it to buy other things. Right? Is that just something you can do in real estate? Because I'm sitting here thinking like I have an old hot rod, right? But it's an appreciating asset. It's old enough and it's rare enough that it's gaining value every year. I could go as far as being able to to pull a loan against something like that to be able to buy.
Exactly. And then so back to what you were saying, right, about real estate. Like, let me bring up someone that he gets drilled. He gets a hard time, right? People give him a hard time. Dave Ramsey.
Yeah.
Because Dave Ramsey, he believes in no debt at all whatsoever, right? No debt at all. Which I mean, I think, me personally, I've never talked to him, but I personally think that the reason why he's saying that is because he knows that a lot of people can't handle debt.
Sure.
If they get lines of credit, what are they going to do? The majority of Americans out there, right?
They're going to act just like most of us acted in college.
Yeah.
Look, free money.
Shopping.
Let's go buy something new.
So I think that's why he's saying that, right?
Right.
So what we're talking about is a little bit, I don't know, more advanced, you could say. But anyways, here's the way I like saying it. Debt is okay, right? To a sense.
Right.
As long as it's good debt. Okay. I don't recommend having, debt for having debt on your credit cards for shopping, for eating out, for vacations, for liabilities, in other words, right?
Right.
But debt for assets, man, like, go get it. Go get it. Like, I don't know how much debt I have right now, and you know what? That's a number that I need to. I'm going to get that number, and here in a future podcast, I'll let you guys know. But I mean, from the 11 properties, right? From the 11 properties, I mean, we're talking about probably, I don't know. I'm just taking a guess, just a real quick guess. Let's say $5 million. Like let's say $5 million. Yeah, no. Yeah, probably around there. Okay, $5 million.
Right.
But that's good debt. That debt is producing income for our family, right? So that debt is okay. If I could find more great opportunities, as a matter of fact, if you know of a great opportunity, email me, call me, let me know, right? I'll go get it. The only reason why I don't have more asset debt is because I haven't found the opportunity yet.
Okay.
I know a lot of people out there know, right? Our baby, right, is MSI Credit Solutions.
Yeah. The
investing is just a side thing, So could I find more if I was out there and that's what I was doing full time? Yes. But I'm taking care, of the baby, right? MSI Credit Solutions. We're all taken care of, right?
Absolutely.
So I kind of just invest in whatever falls on my lap, So, but I'm being serious. If something falls on my lap, right, bring it, bring them, right? I will get $5 more million worth of good debt, right? $10 million.
You said two statements that I think is going to clarify what you're talking about right now to a lot of people. And I know I've heard them before, and I know what they are. But you said a liability versus an asset.
Yep.
Can you tell the people out there what a liability is versus an asset?
Yeah. Everybody identifies it differently, but basically what I like saying. And I heard this, I don't know what guru said this, but basically liability is anything that, and I'll start with asset. An asset is anything that's producing income for you.
Right.
Okay. If it's not producing income for you, it's a liability, basically in a nutshell.
Okay.
So like, for example, the houses that I have, right? They're producing income for me, right? Like that, the house in Plano that I told you that is right now, on the market for $3,500. I think my mortgage payment is, I don't know, like $2,500.
Right.
So as soon as I lease it out, it's producing $1,000 of, a passive income, right? Every single month. That's an asset. The Colony House, same thing. That's an asset. That's why a lot of gurus call your homestead, the home that you live in right now, they call that what? They call it a liability.
Wow.
I like calling it still an asset. Okay.
Right.
Yes, it's not producing a cash flow for you right now. My homestead that I live in right now, Is it producing cash flow? No.
No.
Right? I'm
But it's
paying every
building
month.
value.
There you go. It's producing
Right.
other value for you, right? You're able to write off your interest, right?
Right.
That's some value there. You're able to whatchamacallit, whenever you're making your payment every month to your mortgage company, it's not going to waste. Some of that payment is going towards your principal, right?
Right,
You're paying
absolutely.
down something versus if you're renting, you're not paying down anything. You're paying down your landlord's
Right.
principal, you know? So anyways, an asset, right, is something that puts, money in your pocket. A liability is something that doesn't. But to me, right, some gurus say, no, your home is a liability, right? Get rid of it and rent, right? So, some gurus go that far. They say that,
Wow.
yeah. And my opinion, right, is no. I still think that your home is an asset. And, I give you those examples. Maybe it's not giving you income every month, but at least your payment is going towards something. Okay,
Right.
You're able to write off the interest, and then what you said. Go look at historically, right?
Right.
Real estate, what does it do? It
It-
appreciates.
Constantly,
That's
yeah.
free money. That's free
And there are
money.
not a lot of things that you can own for a long time.
Yep.
And
Yeah.
and have them gain value. I
Exactly.
mean, you're talking about some rare collectible
Yep.
items, some special types of
Yep.
cars,
Yep.
and homes, and that we're about at the list,
Yep.
I think.
Yep.
Of
Yep.
things that the longer you have them, the more monetary value they have.
Yep. And let me interrupt you for one quick second. Speaking of other people's money, right? I have a story of how I used other people's money. I mean, I do it all the time, but this is a funny story. My first home that I ever, my first investment, my first flip, okay, my first flip,
Right.
was a home in Plano, Texas, and I bought the home with a little bit of cash, okay, that I had. I didn't have the full amount to buy the home completely myself. Okay, I
Right.
think they sold it to us for $200. Okay, I didn't have the full $200 cash, right? So, but I did have the $100, and so what I did is, here's what I did: I went halves with someone else. Okay,
Right.
so now he had to come up with the $100, I had to come up with the $100. Okay, so at that time, right, I had the $100, cash, so I did that.
Right.
But now the repairs. I depleted the $100,000
Wow.
that I used, right, to buy the home
Yeah.
was basically my money, all my money, right? So now I have $0. So what did I do for the repairs? The repairs were like another $100,000,
Right.
Right, but because I went in it with a partner, right? Let's say the repairs were $100,000. We split those repairs: $50,000 me, $50,000 him, right?
Yeah.
So I'll tell you what I did, and then what my partner did. So for the repairs, I didn't have the money. You're probably going to guess what I did. What would you have done?
Not having money, went and got a loan against my equity is the first thought I was having, or get a loan.
Well, no. Let's say you can't get a home equity line of credit on a home that you just bought.
Right.
That you just you're rehabbing right now, right?
Oh, I was thinking about your personal
I
home.
use my credit cards.
Right. Credit
so,
cards, yeah.
So there you go. I used other people's money, the credit cards money, to rehab that home. So I used $100,000 of my own, and then the $50,000 in repairs, I used my credit card, right?
Okay.
And then when we sold the home, right, there we go. I was able to pay off the credit cards. I was able to replenish my savings of $100,000 and some, because there was a commission
Right.
after I sold the home, right? Not commission, but there was profits whenever
on it.
I sold the home. But anyways, in that example, that home that I bought in Plano, my first flip, there was all different types of examples of other people's money. My partner, okay,
Is one.
He didn't have the $100,000 to buy his, for his half of
Right.
of the investment opportunity, and he didn't have the money either for the repairs.
Right.
So what did he do? He did a hard money loan. He asked me, what should I do? He's like, go get a hard money loan. Here's a contact here. Call him up. He called the hard money lender. He had to have a little bit of money. The hard money
Right.
lender wants you to have a little bit of skin in the game, right?
Yeah.
They're not going to just finance the entire project, right? They want you to have a little bit of money, a little bit of skin in the game. So anyways, that's what he did. And the cool thing about the hard money lender is not only will they fund the house,
Right.
but they also fund the repairs.
Okay.
Yeah.
Wow.
Yeah, they'll fund the repairs. So that's what he did. His side, he used a hard money lender, right? Other people's money to buy the home and to do the repairs. Me on my side, I used my cash, to buy the home.
Right.
But for the repairs, I used my credit cards.
And other people's money there too.
So it's just all around us already.
And that's a great point about showing how to leverage your debt and the difference between an asset versus a liability. It was an asset. It was an asset at that point. You were leveraging your debt to get an asset that's going to make you money versus, like you said earlier, going out shopping, going to dinner, going on trips and things. You're leveraging your debt to be able to produce more money for you.
Yep. So yeah, I mean, I recommend to everybody, the things that I was talking about, right? Credit score, try to maximize your credit score, improve it, get it as high as you can. Make sure you're reporting income. Make sure you're reporting income, because whenever you use other people's money, the most common, thing, the most common area where we use other people's money is from the bank, right?
Right.
So what do the banks typically require?
They're going to look at your credit report.
It's credit score, right? It's verifiable income, and then also be good with your money. Be good with your money, and have low debt, because they look at your debt to income ratio, right?
Right.
So have low debt, and save up money, because you having money stored away, even if it's not a lot, right? $5,000-$10,000, right? They like that. They like that. They like to see reserves, is what they call, right? It just makes your file look better.
When we had to buy our house, they wanted to have like $15,000 in our account.
Have some reserves. You have the credit score. You have verifiable income. You have low debt, right? Now you could go talk to banks about getting, whatever you want, getting loans. There's different, like I said, there's different types of loans. Home equity line of credit, cash out refinance, just getting a personal loan. I mean, there's just so many ways, So yeah, I mean, and once you do, get everything aligned, go try to find, the financing. Go try to find the financing, even if you don't have the opportunity yet, because that's what happens to a lot of individuals. A lot of the individuals are out there looking for investment opportunities, but it's just like buying a house.
I was about to say the same thing.
You don't go look at a house first, right?
Right.
You go get pre-approved first, then you go look at homes, right? Same thing with investing. Go talk to a hard money lender. Get your credit in tip-top shape. Are you reporting income? Try to get your debt, as low as you can. So if you have credit card debt right now, try to get that, as close as you can to zero. And then really, I mean, once you're there, right? If I was you, try to start executing as far as getting, loans. And kind of like I said, once you do get some loans, don't rush into it, right?
Right.
Don't rush into it and then get in trouble, because that could really be a huge setback. I mean, knock on wood, to this day, I haven't, invested in something that, wasn't a good investment.
Right.
But knock on wood. But I could attribute that to, taking your time and only pulling the trigger on something that makes sense. The numbers make sense. Pull the trigger. Yep.
Okay. Minimize your risk is what you're saying. Don't jump into the first thing that comes along.
Because the opportunities are out there.
Right.
They're out there, But definitely don't. There's different personalities out there, right? I think I'm a little risky, not the riskiest person out there, but, there's some conservative people. There's some conservative people that might see an opportunity out there. And once they see the opportunity, they have to go run their numbers. They have to go talk to people. They have to go, pray about it. They have to go talk to, 1,000 people about it. And then finally, 30 days later, when they decide that the opportunity is good, they go back to the opportunity. And guess what? The opportunity's gone. Yeah.
That person really needs a home equity line of credit. They need to take that step out of there.
Yeah. So definitely, do your homework, and once that opportunity comes, execute it.
So talking about the credit score, I actually have a curiosity question. Mm-hmm. Would you recommend, if somebody was going to do something like a home equity line of credit, they were looking to do that type of thing, and they need to get some debt paid off, would you tell them to pull out like a loan and consolidates that type of thing? Wait till they paid it down,
Okay, so
to get the best possible score that's out there, like paying off all their credit cards and stuff.
if someone has, okay, so repeat that again.
Let's say somebody has wants to be able to, pull get a home equity line of credit.
Okay, so they don't have one. That's where
Right,
okay.
they don't
so
have
they don't have
one.
home equity line of credit,
Right.
but they want to get one, and then keep going.
And they want to be able to get the best possible credit score before they do.
Yep.
Right. Should they do something like get a loan to be able to consolidate down all their debt?
Yep.
And then pay it off?
Yeah, so that's a good question. So for the sake of your credit score, if you're just moving around debt, right? Like you had this amount of credit card debt and you transferred it over to another credit card, whatever, right?
Right.
That's really not going to do much to your credit score at all. You're just moving it around.
Right.
You had I'm just pretending here. You had $40,000 worth of debt on your credit report. When you moved it around, how much debt do you have now? $40,000 still, right? So that's not doing much there. I would move around debt. Move it around as much as you can if it's going to save you money. If you have a bunch of credit card debt and you're paying 30% interest rate on the credit card,
right?
But you could move it to a personal loan that's going to charge you 6-7%. I don't know. You could move it to a credit card balance transfers. Maybe we'll talk about that here later on, right? You balance transfer that debt over here to this credit card, and this credit card says, hey, for the first year, we're not going to charge you any interest on this debt that you transferred over. Yeah, do it. You're going from 30%, right? Interest rate on this credit card to 0%, right? Because they allowed you to transfer it over.
Income.
That helps out. Yeah. So and it'll definitely help you out with saving money, because you're not paying any interest. Over here, 30% interest. I mean, whenever you make a payment, a lot of that's going towards, interest.
Right.
So yeah, moving around debt for the sake of saving money, do it. If you could find cheaper money, right, than the current debt that you have right now, move it around. Move it around as many times as you need to, for the sake of saving money. But for the sake of your credit score, I mean, moving around debt's really not going to do much, Yes. Now, let me kind of get, off track a little bit. So they say, right, the bureaus say that they penalize you more for having credit card debt. We talked about this a while back.
Right.
Than installment debt, right?
Correct.
Why do they penalize you more for having a credit card debt? Because they said that your credit card debt is your wants, right? It's your shopping, it's your eating out, your luxuries, right? It's your vacations, right? And your installment is your necessities. It's your student loans, it's your car, your auto loan, it's your mortgage loan, right?
Right.
So yeah, so if you could move debt from revolving debt to a installment debt, and the installment debt has a lower interest rate. Now, once again, I'll use the same term I used earlier. You're killing two birds with one stone. Not only are you saving money because you went from 30% credit card debt to now your debt's over here on this personal installment loan of 5%, right? So you're saving money, right? More money, more your payments going towards principal versus interest. But on top of that, right? On top of you saving money, you're also going to help out your credit score because why? Of what we just said, just a couple minutes ago, which is, credit card debt affects your credit score way more than installment debt. Yep.
So that's a brilliant way again to leverage your debt and the types of debts you're using. To get in a better position to be able to, invest and make your money work for you.
And that's why we say, when we our intro, right? More than money, it's about empowerment, right?
Yeah.
You have to educate yourself and, get empowered, and it'll help you make, better decisions. It'll help you leverage, your credit because leveraging your credit is a big tool. I mean, it's a big tool. I mean, a lot of these gurus, I mean, they're executing what we're talking about. They don't have $5 million worth of good debt, right?
Right.
They have hundreds of millions of dollars worth of debt. Yes.
That's numbers that you sit back and think, and they're possible.
And watch, that's one of the things that I'm working on, next. And you could ask me later on and see it, how it's going for me. But so check this out. The last two properties that I bought, and we could talk about this if it interests anybody, here later on. We'll do another podcast about this. But the first couple of homes that I bought, I did them under my name. The loan is under my name. Okay.
Right.
It's under my name. And so anyways, the last two homes, this Plano home and the Colony home that I talked about earlier, those are financed through my LLC. So,
All right.
So when you finance it through your LLC, that's called do you know what it's called?
No,
commercial
you got a commercial loan. Yeah,
it's a
I
commercial
did
loan.
know that.
Yeah.
Sorry, you got me on that
Yeah,
one.
so it's a commercial loan. And so why am I doing it? Okay, aside of you putting your what's one of the main reasons why someone puts their investment opportunities, their real estate investment opportunities under an LLC? What's one of the main reasons why?
Well, I can think of at least two. One is it reduces the liabilities on
There
your
you go.
personal
That's the main
property.
one. Yep. Liability, right? Because now if I don't know if one of your tenants falls and breaks their legs, they can't come after you personally. They could only come after the LLC and what the LLC owns.
Right.
And if the LLC only owns that house, the most that they could get from you, right, is that house. They put a judgment on that house, right?
Right.
Versus if you have it under your name, now they could get a judgment and try to get more than just one house. So anyways, but the second reason why I'm going for the commercial loan, okay, and it's the subject that we're talking about. It's so I could try to scale this other people's money, okay?
Right.
And here's what I'm talking about. So now I have two loans, okay? I have two loans under my LLC. So my LLC is now, and then this LLC that I have, right? I also have a credit card. Okay, we'll talk about this
Right.
another day. But I have a credit card. I recommend that if you open up an LLC, get a checking account, for that LLC.
Right.
Get a credit card for that LLC. Start building the credit.
Absolutely.
Okay. So this LLC that I have, right? Checking account, credit card, credit cards. I have like two, and then now, right? I'm starting to put these investment opportunities under the LLC, but here's what I'm trying to go over with everybody. So watch. Now I'm building real estate credit,
Right.
for the LLC. Why am I doing that? Because we're hoping, right? And if my, the banker that helps me out with the LLC loans, right, the commercial
Yep.
loans, here later on, I want to ask you for $10 million, $5 million, $20 million, maybe for a building, whatever, an
Property and
apartment,
profitability for your business.
Yeah. So I know that you have to take baby steps. So right now I have two, my LLC has a checking account. My LLC has a credit card that I've had for a lot of years now. And now it has two properties, because here later on, I'm going to ask you for as much as I can to maybe buy an apartment complex, to maybe buy a high rise or something. I don't know. We'll
Right.
see, So because I truly believe in good debt,
Right.
in good debt,
Can you sell your house to your LLC, or can it become? Can you put it under there?
Yeah, but then you lose your homestead benefits,
Okay.
your taxes, your
Right,
tax.
you're
You
right, you're right.
won't get your tax benefits anymore because it's your homestead's in your LLC, And then you might say, well, I'll be protected. You're already being protected,
Right.
In Texas, not all states. In Texas, if you have a homestead, right, it protects you from creditors. So
Wow.
a homestead here in Texas and other states, it protects you from creditors and then also tax benefits, right?
Right.
Two things, two benefits. So if you put your home under your LLC that you have right now, you're gonna lose the tax benefits, and then it's like a wash with the liability.
Right.
You're being protected right now, in Texas, from creditors because it's your homestead.
Right.
If you put in your LLC, you're also being protected.
Right.
So my personal advice: your homestead, keep it under your personal name. So that way you can get the tax benefits and you're being protected. But anything future, put it under the LLC if you can.
That's awesome.
Yep.
That's some great stuff, man.
Yeah,
I was excited about this one because it's
Yeah.
something I personally wanted to know
Yeah.
more about
Yeah.
because I wanted to venture into that
Yeah.
world. That's where I want to go next.
And I was excited about it too because, I want to keep going further into it, Yeah, whenever I first got started, right? Yeah, 11, 10, 11 houses was a lot to me, right?
Yeah.
But now that I'm here, right, and all around it, in it, knee deep, you could say.
Right.
I want to go deeper.
I can imagine because it just sounds amazing.
Yeah.
Sorry.
Yeah. And I'm telling you, it's start off with what I just mentioned. It took me years to be able to, first, start off the process. Work on the things that I told you. If you don't own a home, I recommend go ahead and get your first house. Go get your first house because once you get your first house, we talked about it. You mentioned it, right?
Right.
You and your wife are trying to do it. A home equity line of credit.
Yeah.
And once you get that home equity line of credit, because a home equity line of credit is easier to get than just building your credit score, having a little bit of reserves, having a verifiable income, and then going to the bank. Hey, can I borrow $500,000? They're more than likely they're going to tell you no, even though you built yourself up. A home equity line of credit is easier to get. Why? Because they're going to put a lien on your home.
Right.
Right? So there's collateral. So think about it. So with the home equity line of credit, you have to have the credit score, okay? You have to have, good verifiable income. You have to have DTI, right?
Right.
But think about it. It's low risk for the bank. Then they get to put a lien on your home. If you don't pay the home equity line of credit, they put a lien. There's a lien on your home, right?
And
So-
and you're people who own a home typically are safer
Yep.
with their home than than somebody who is
Yep.
a rental person and
Yep.
they could go anywhere.
Yep.
So you're more of a stable
Yep.
client for them.
Yep. So one of the easiest ways to start off with other people's money, aside of credit cards, right? Get
Right.
credit cards, right? You just heard the example of I bought, I funded all the repairs on my first flip with a credit card, right? So there's so many other stories out there that I have about how other people leverage their credit cards for investment opportunities, but we'll save that for another day. But a home equity line of credit, right? So what I would do if you don't own a home and you want to start using other people's money, like I said, right, credit score, try to get your credit score as high as possible, have verifiable income, keep your debt low, try to, save a little bit of money, for reserves. And then if you don't own a home, buy a home, right?
Right.
And then just organically, you're going to look up 2-3 years later, your home appreciated, you paid your balance down, right? If you have equity, you could go to your bank and try to get a home equity line of credit. Now you get that home equity line of credit, and now you have whatever it is, $50,000, $100,000, $150,000, $250,000. I got blessed that the home that I took out a home equity line of credit, I did it during COVID. If you're not aware, during COVID, homes appreciated,
Tremendously.
record breaking, right? So we bought a property in Colorado. We bought it for $480,000, and during COVID, it went up to $1 million. Yeah.
Wow.
So guess what? Empowerment, right?
Yeah.
What did I do? I ran to the bank. Give me a home equity line of credit. They're like, okay, let me get it appraised. Okay, $1 million is worth. Okay, how much do you owe? We owe like low 400s. Okay, and they gave me a $530, I think, $1,000 line of credit. Yep.
Wow.
So yeah. So right now I have it maxed out. I have it maxed out. The way that I leverage that line of credit is I built my current house that I'm building right now with that line of credit. So this will be the last story, right? So in other words, I built the home that I'm building, you could say, through the line of credit, okay?
Right.
Once this home is built, 45 days, I'm going to move into it, okay? Now what I'm going to do is I'm going to sell the home that I live in right now.
Right.
And with that equity, without money that I have in there, I'm going to pay off the line of credit. If I didn't have that home equity line of credit, here's what I was going to have to do, okay? I was going to have to, okay, this is my house I live in. I'm building this house, okay? I was going to have to sell my home when I started building the home,
Wow.
go move into an apartment, go move my kids to an apartment, right? This house took 2 years to build. Move into an apartment for 2 years.
Pay the rent.
Why was I gonna have to do that? To get my money from that house. In other words, sell this house, get the money, fund this house that I'm building over here while my house is being built, right? Live in an apartment, and then move again. You know, I didn't want to move inconvenience, right?
That's rough on you and the kids.
The kids.
And your wife and
that's
everybody.
Double movers. Move from this house to the apartment, from the apartment to here, right? Just double movers. Just, yeah. And then it took 2 years to build a house. I was going to be paying rent at an apartment for 2 years, right? I mean, wasting money there. So yeah. So there you go. That's another story of how I leveraged how I leveraged other people's money to not inconvenience my family and actually save money.
Right.
By not throwing money renting, I save money. By not paying for 2 movers, I save money. And
so the way it sounds, you're going to literally walk into this new home pretty much owning it.
the new home?
Yeah.
No, because it's I financed.
Okay.
I had to use some of my money, but then I financed a big portion. So no,
Okay.
yeah. We'll have a note on it.
All right.
Yeah.
I thought that's what you were getting. I was
No.
about to go, that's impressive.
No. We have a note on it. Yeah. Awesome.
I
Yeah.
love it. That's thank you for. Thank you. That for me personally, seriously, you've actually lined out my plan.
Yeah.
Just talking to here today.
Yeah.
I mean, my wife and I have. We were talking on where we want to go. A HELOC sounds like right now for us. A HELOC sounds like the right choice for us.
Yep. And then once again, I'll use the same term for the third time today. I killed 2 birds with one stone today, again, with you, because you had expressed interest in this subject.
Right.
Today, I was able to educate you and others at the same time.
Absolutely.
Right?
Absolutely.
Yeah. So, hopefully it helped you out, and hopefully it helps out, individuals out there.
I hope so. Thank you very much for watching MSI Wealth Chronicles today. As you can tell, we all have something to learn. Myself today, I actually have in my mind where I'm going to be going for the next steps, and my wife and I are going to talk about it tonight.
And I'm going to hold you accountable.
Please do.
Just like I said earlier, you could ask me later on, hey, how's your venture going with the commercial, venture that you're trying to go for, right? I'll tell you. But I'm gonna ask you too where you're at with your steps towards getting your home equity line of credit.
Please do. So for myself today, building legacies one episode at a time. MSI Wealth Chronicles. Thank you for tuning in. Put your comments down below. Ask questions. We want to hear them. We want to answer them. And keep us, also keep us responsible. Ask us about the things we talk about in these podcasts and see if we follow through with them. Look forward to talking to you.